First, I show that common supply and demand fundamentals, such as the growth in emerging Asian economies, cannot explain the extreme energy prices. Instead, I find, and this is the second main finding, that the in and outflow of speculative money from financial market players help explain extreme price fluctuations. Specifically, the in and outflow of money from hedge funds significantly helps explaining extreme price rises and falls in these markets. Of course, real demand fundamentals still apply. In fact, they determine the mean price levels in regular times, but I show that price movements in extreme periods are different. In other words, the real demand cannot explain the extreme highs and lows. Over the past decade, energy commodity prices have shown dramatic rises and falls, which have not been observed since the energy crisis in the 1970s. And at the same time, over the last decade, energy markets have experienced an impressive increase in the financial investor participation. And this has led to a heated debate about the role of speculation in energy markets. Also, many market observers were especially puzzled about the joint occurrence of large price falls and rises across very different energy commodity markets. Well, a boom with high energy prices, rising energy prices across the different markets goes along with significant purchases of hedge funds. A boom is also associated with increasing purchases from index traders. Both purchases will amplify the rising energy prices. In contrast, a bust with low energy prices, falling energy prices, is mainly associated with massive sellings of the hedge funds. This will amplify the price falls. In addition, in times of crisis, often related to busts, financial investors are forced to liquidate their commodity holdings across different markets at the same time, and this will further amplify the price falls. So we will often observe commodity price busts in periods of financial turmoil. I used energy futures data from 2006 to 2012 for 6 different energy commodities, which are included in the popular Standard & Poor's Goldman Sachs Commodity Index. Namely, I used data for WTI crude oil and Brent crude oil, but also for heating oil, gasoline, gas oil, and of course natural gas. In my personal opinion, the results provide some empirical support to the recent policy efforts to regulate energy commodity markets as part of the recent efforts of the G20 to provide financial stability. Often policymakers are very concerned about the anomalous propagation of extreme prices, which may be disruptive to their economy. So in this slide, my result that financial players seem to amplify price shocks may inform policymakers in the debate about commodity market regulation. Yes, in fact, new regulatory limits would only be justified if speculative trading was at the core of the problem. My study, however, only provides evidence that speculative market conditions are associated with extreme price fluctuations. However, this does not necessarily imply that speculative trading is also causing the extreme price fluctuations. And further research has to investigate the cause and effect between speculative trading and price fluctuations.